And Mark Ostwald joins us now from ADM Investor Services with his view on what today's election result means for the markets. Mark, first of all, the commentary we've had from the German EU Commissioner suggesting that this changes everything for Brexit, the French Prime Minister saying, no, it doesn't change anything. What have we got here as we wake up on Friday morning in terms of the outlook for the British economy and for the markets?
Well, in terms of the negotiations on Brexit, I think the EU Commissioner is correct in the sense that obviously they won't get off to a quick start. The idea was that pretty much almost instantaneously there would be the start of negotiations. First of all, we need to form a government here. So, secondly, it's the Liberal Democrats here have ruled out any form of pact or coalition. That leaves the Conservatives with but one choice as a coalition partner, the Democratic Unionist Party in Northern Ireland, which in itself brings certain problematics because obviously Northern Ireland, with its border with Southern Ireland, is a key issue in those negotiations. More importantly, if Mrs May is going to hang on, then we're probably going to see at some stage someone else challenge her for the leadership. One can only describe going from what was mooted to be something like 100 to 150 majority to a hung parliament as being one of the biggest mistakes ever made in election history. So where does it leave the UK economy? Well, I think the biggest negative that it leaves is, first of all, in terms of those negotiations with the EU, in the sense that they would have been hoping for a clear government which would have a clear negotiating stance. Even if they disagreed on items, they would at least then know precisely where the UK was coming from and they would know their own stance. In this situation, they may feel actually that the biggest risk is that they start negotiating. Britain puts forward various ideas that it's, of what it sees as its ideals, and then finds that having had internal party or coalition negotiations, that they then start to backtrack, which is exactly what is not needed. It's a very, very narrow time frame for negotiating all of this. Secondly, I think most importantly in terms of business investment, for anyone, whether they're foreign investors or whether they're domestic investors, the uncertainty surrounding both the Brexit negotiations and the prospect of a probably likely very shaky, if not unstable government, is a big detractor from making any investment decisions.
So why in that case is the FTSE up so strongly? What were you 40 minutes into the session on this Friday?
I'd love an answer to that. I think the situation is that sterling's obviously fallen. We are still very much in an era of financial repression. So when people see a currency fall quite sharply, their instinct in this era in terms of reaching for potential areas of return is to reach for those indices where you've got a potential for a rally due to the currency fall. However, one has to observe, if this were pre-QE days, one can't really imagine that we would be in this situation where you've got the FTSE up almost 100, almost up 1%. Though one has to say the FTSE 250 has fallen, thankfully, which is much more representative of the UK economy. You would probably actually be in a situation where sterling would be a lot weaker than it is. The fall thus far, I would say, I would call it measured, particularly when one looks at it relative to last year, when one saw that very precipitous fall. And you'd probably have the FTSE 100 down something in the region of 200 points. So it does underline that we've got markets whose reaction function at the moment is extremely impaired. But in the longer run, I think the key point is none of this, of what has happened overnight, is necessarily going to be positive for UK assets.
How about the longer term picture? Because Brexit aside, we already know that the UK economy is beginning to falter. Bank of England meets next week. Is there anything the Bank of England can do? Of course, when we had the Brexit negotiations outcome, the referendum, I should say, last year, one of the first things the Bank of England did was cut interest rates.
Yes, and with hindsight, I think a lot of people would be questioning the wisdom of that. It certainly seemed to encourage a big surge in consumer credit, which people can ill afford in this country. You've got consumer credit growth at 10.5%, you've got average wage growth at 2.3% and inflation at 2.5%. That is not something which is sustainable. What can the Bank of England do now? Well, the answer is not really a lot. Probably keep a steady hand on the tiller. And wait to see how the economy evolves. I think having jumped the gun last year, in the sense that...
Well, you're saying that they shouldn't have cut interest rates at that point?
I think they were very precipitous, and they are now saying, well, the economy's only been relatively strong because of what they did, which of course is a nonsense, because we know that it takes 6 to 12 months for rate decisions to feed through. But right now, A, they haven't got much room on rates. B, inflation is very elevated, and they do have an inflation target. On the other hand, they can't tighten policy for the simple reason that the economy is showing signs of faltering. So their best bet would actually be just keep a steady hand on the tiller and say, as the ECB loves to say, that we stand ready to act in either direction. So keeping a steady hand on the tiller is probably the most important thing.
And that presumably includes more QE here in the UK? Do you think that's a possibility? It's something it's presumably in the background.
I think it's certainly got to be considered to be a possibility. If the economy starts to slow even more, it can't be ruled out. Whether that actually helps the economy in this situation, I have my doubts, because this is not really a problem which can be solved by a monetary policy. What you need is a far more strong and stable, which we haven't got, political backdrop.
In your job, you allocate resources, you allocate funds. What is the key trade out of this? Where should the money go?
Well, I think we've seen the trend over the last couple of months, particularly since the French election, that there's more money being allocated to Europe, to the Eurozone. Eurozone growth is much more encouraging, and that, in a sense, is quite a good thing for the UK, in the sense that the UK's main trading partner is still the Eurozone. But that would be my natural instinct. The US still stands under a bit of a cloud. And the charge that we've seen into emerging markets of late probably is slightly overdone at the moment. So the Eurozone and indeed the broader EU, countries like Poland, Czech Republic, Hungary, all strongly growing countries, are probably the places to look at.
Yep. Okay, all right. Mark, thanks indeed there for your time. Mark Ostwald from ADM Investor Services.